The following is a presentation of TFNN. The Options Hour, brought to you by Think or Swim. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, The Options Hour.
And thank you for tuning in. This is The Options Hour. This is Chad Coco with Think or Swim by TD Ameritrade. If you have any questions during the show or want to talk through some trades, feel free to call at 877-927-6648. Internationally at 727-445-1044. You're also able to email me at support@thinkorswim.com. That's an email, a catch-all email box here at Think or Swim. We'll answer pretty much any kind of trading question or question about the market or Think or Swim, anything related to any of that world. Again, that's support@thinkorswim.com. I'll answer the kind of questions that get in there on the air. As some of the stuff from today comes from that, as well as from the Money Show, which I'll mention in a minute. But first, a quick disclaimer, because we will be discussing securities at today's trading prices. None of the mentioned examples are recommendations. Simply using securities to illustrate a point, bring some clarity around some ideas discussed. Options can contain some risk, so please evaluate these products to determine whether risk is suitable for your portfolio. Into market headlines, prelim gross domestic product, the value of all the goods and services produced in the U.S., rose at a 3.9% annual rate. This is up from an initial estimate of 3.5%. This is after the 4.6% increase in the second quarter. This marks the biggest back-to-back advance since late 2003. You can see the market's responding favorably to those numbers. The FDA, this is an article that I found kind of interesting. So the FDA will publish sweeping new rules today requiring chain restaurants, movie theaters, and large vending machine operators across the country to post calorie counts on their menus and menu boards. So what struck me on that one was the movie theaters in there. So theaters take 85% of their profits generally from concessions. So they're going to have to start publishing the calorie content on those concessions. So you go into a theater, buy your large popcorn, large pop, don't really think about the calories in that, but could be quite substantial. Those posted there could potentially hit some of the bottom lines of these large movie theaters. What I did notice, though, when I was looking at these companies, so the three biggest one, Regal Entertainment Group, they're actually up today. Another one, AMC, I believe they were up earlier. I believe they still are as well, also up 1.5%. And then CNK also up considerably, or they were up earlier, I believe. I'm sorry, that was wrong. Symbol CNK, they were up earlier, and they still are up, even on the news that this could potentially hit their bottom lines. Other news in the retail world, Tiffany & Company reported their Q3 earnings today. They came in at 76 cents versus an estimated 77 cents, so they missed by a penny. Their earnings per share were up 4% from the same quarter of last year. The revenues came in at just under $960 million versus $970.5 million estimate. Sales were up 5% year over year. So they also revised their outlook on growth to a positive from mid to high single-digit range, and affirmed their fiscal year earnings per shares average about 420 to 430. On that news right after earnings, little pop, that was this morning on the open, and then they rallied up and coming back down, see if they fill in that gap that caused there. They were trading quite above their standard deviation. The expected move on this was quite a bit less than what we actually saw here. So we'll see if that pulls back a little bit more. But good news in terms of luxury retail. Another symbol that I was following, kind of similar to that, Michael Kors, not necessarily as luxury as Tiffany, but still considered luxury good. They rose on news here as well. Those are the main market highlights that I saw. So since it's a shortened week, we had some of the numbers, the Fed numbers and whatnot, were pushed a little bit closer together. So nothing's being reported on Thursday. Today we have FHFA House Price Index. That came in at 0% flat on a 0.5% estimate, so slightly lower there. Didn't really cause much movement in the market when those numbers came out. Pretty flat on that. The S&P Case-Shiller HPI came in at 4.9% on 4.1 Something else that I saw was kind of interesting was the Richmond Fed Manufacturing Index was estimated at 17, came in at 4, so considerably lower there. Once that number, then also the consumer confidence numbers, which was estimated at 95.9, came in at 88.7. Both those numbers caused potential little turbulence in the market, a little bit of a drop. We can see those right about here on the SPX chart. We're taking a look at those. Tomorrow we're going to have durable good orders, jobless claims, consumer sentiment, new home sales, pending home sales index, and 7-year note auction. Thursday's a holiday, obviously. There's no numbers being reported there, no domestic numbers anyways. Then Friday we have retail sales. We have seen that some of the retailers have started to report positive numbers, and that's, for instance, Best Buy. Big bump on the retail sales recently. Let me turn that back into a daily chart and see how that looks. You can see the last earnings per share numbers beat estimates. They're just generally doing better. So hopefully that carries on to all retail sales as we look at that on Friday. Consumer manufactured goods consumption is also on Friday, as well as the CPI, so Consumer Price Index, Producer Price Index, unemployment rates, and Chicago PMI. So a lot of information coming out this week, even though it's a holiday, but nothing on Thursday, obviously. Hopefully you enjoy your Thursday off. Thursday is a market holiday. Most brokers are going to be closed, but we definitely are. Exchanges are closed, and then Friday is a shortened day, so abbreviated trading, I believe they close 2 or 3 hours early. I think it's 2.5 hours early from normal. I could be wrong on that. Maybe it's 2 hours. Anyways, so keep that in mind. So if you're trying to get out of positions on Friday or try to get into positions, markets do close a little bit early, and your broker probably does as well. And then in terms of earnings, I mentioned Tiffany had their before market earnings, which turned out positive. Hewlett-Packard is the only other real big one that's coming out. They come out after market today, estimated at $1.54. See how they perform on their earnings here. That probably won't have a whole lot of movement in the market. Take a look at what the market maker move is on this one. Since the back month is higher than the front month, they're not getting a market maker move on this, but we can kind of figure that out by pricing out a straddle. So if we look at the at-the-money calls and puts and take a value of this, so if I'm just going to go buy a straddle and see what the value is on that one, about $1.56, so about a $1.60 move estimated on their earnings up or down. That's some rough math. I'm going to get into a little bit more of that later, but this is a good way to judge how much something is expected to move. That's how the market makers are pricing it off real quickly anyways. So that'd be today after market. Tomorrow we have some earnings as well. Deere & Company, John Deere, will be before market tomorrow. So if you're looking to do some earnings plays that I mentioned in previous shows, this might be a simple last one for the earnings season is really to take a look at. They're trading pretty much flat on the day in preparation for those earnings tomorrow. They did have a little rundown last week, then the volatility and the price moving up kind of shot the option prices all over the board. We're looking at implied volatility, 67% percent in the range there. The actual options volatility, and that's about, I think, 40%. Yeah, about 40 for that front month for those earnings. So if you pay attention at the very beginning of the show, I mentioned that I was at a trade show. If you were listening to some of the presenters on TFNN, they were there as well in Vegas. And from that, I had a lot of FaceTime with a lot of clients or potential clients or other just traders in the industry, and had a lot of questions. The show today is going to revolve around the questions that I had. They're the most common ones, as well as some questions that we get in through email that I think may benefit new options traders or maybe intermediate options traders. If you're an advanced options trader and you're looking for some more help on that, definitely shoot those over as well. Not really sure how many of those are listening out there, but if you are, I'd be glad to hear from you. Again, the number to call in is 877-927-6648. I can always email support at Thinkorswim as well. So I'm going to start with the most high-level question here that I got. So there's a lot of stock traders, a lot of futures traders that we saw at the trade show. Not so many options traders per se. Did come into some, but not as many as I was really expecting. And one of the main questions was, why trade options over stock? Just blatantly, you can get a lot more leverage on it. So if you're looking to trade stock, you can get a bigger percentage gain with the same dollar amount that you would put up for your stock. let's just run down that real quick. So, for instance, if we were looking to trade John Deere and I had, say, $1,000 worth of that, wanted to purchase some shares of John Deere, let's do this math for me real quick. I want to calculate it all out. So $1,000, that's really going to give me, I don't know, see how many shares I'll buy. And we bought 11 shares of John Deere there for that $1,000. Whoops. Mouse is being a little jumpy. Come back to my trade tab, all products. So 11 shares of John Deere, so we have that added in our account. What would happen if I have the same kind of bias? We've gone over different types of option strategies here. If we wanted to purchase some shares of stock to really do some options to really do the same type of thing as the stock would, the most common thing that people would do would be buy a call. So definitely we can buy calls in the shorter expirations. That's going to give us lower price options because we lost a lot of time on that. We get a lot more bang for our buck off the shorter term options. So for instance, if we were going to buy $1,000 worth of the just one strike out of the money calls, it's really going to give us quite a bit more. I could do the simple math in there, but just have the software do it for us. And within Thinkorswim, if you're watching the Tigers game, then you can see that I can put in a dollar amount for my order. I don't actually have to calculate how many shares to purchase on there. It will do it for me automatically. So if you're looking at the order ticket, just to the left of your quantity, there's a little button where you can click between a number of shares or contract, percentage value, which is really designed for closing positions, so you can do it here as well, I guess, or dollar amount. Put in $1,000 and click confirm and send that, and that should give us a fill. Then now we're going to pop over to our Analyze tab, take a look at these two different trades in combination with each other. So the stock, I got 11 shares of stock or 8 options. For a dollar-to-dollar move, we're going to see which one actually performs better. Really, if you're trying to use options to do a synthetic stock position, you'd either buy a leap. The leaps are long expiration options, the long-term expiration options, or you'd buy a call and sell a put. Both of those would have a 1-to-1 ratio move with the stock. But just for real simple here, we're going to keep it with just a stock and option, or just a stock and the call, see how this functions. Let me reset my chart so I have a nice clean interface to work with. So we're trading at 87.88. If we go up 10% in the stock price, it makes me a $96 profit if I just own the stock. In the options world, that 10% gives me a $5,000 profit. Again, this stock, long stock in this case, with a 10% move up, $90. The stock $5,000 on the same dollar amount of investment. After this commercial break, we'll come back and answer some more of these questions I had.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. We take your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Options Hour.
And welcome back. We were just discussing the differences between the call, just a long call, and what long stock would perform in the portfolio. I also wanted to talk, or to touch on some other portions of that. So when you're using your stock, of course you can use margin to purchase on that, but you also are potentially paying interest on those margin rates there. So we're going to try to not do that in that situation. Some other reasons you potentially would trade options over just particular trading stock is you can profit from dropping prices with limited risk with options. So, for instance, if we believe the stock's going to drop, we can do a put. So we can buy a long put, which would limit our risk based on just the cost that we purchased that put for. Where if we were just to short the stock, we have the potential of that stock running all the way up to, who knows, potentially like $700, $800 on an $80 stock. Not very likely, but that potential is there, and we have a substantial amount of risk there on just the short stock. We can also do risk-defined trades where we're not going to risk a ton of capital on a particular trade, where in the stock there's not necessarily something that's risk-defined, because the stock can always drop down to zero, or if you're short, go shooting up to the moon, in which case you could have some substantial risk there. But with the different strategies that I've mentioned on the show here, you can see that you can limit your risk on that. On top of that, so some other benefits of trading the options. If I do happen to have long stock in my account, I can generate more income in my account even with no movement in the stock by using the options. So, for instance, I'd sell some covered calls on that. In this case, I was adjusting the position. I was showing somebody in the office here or something as well. Basically, we're just selling calls to lower the cost basis of the stock. So provided the stock doesn't move too far, we'll be able to collect a little bit of premium on that and potentially lower the cost basis on our particular trade. And if the stock goes way against us, if I sold the call higher than what I bought the stock for originally, I'm selling the stock for a profit if it gets called away from me, if I don't get out of that position before that occurs. It's not necessarily a lose there either. On top of that, so we can pay less to enter long positions. I sell a lot of puts. If you listen to the show, you probably picked that up. What this is really doing is going to give me the ability to purchase stock at a lower price or just collect the premium that I sold those puts for. going to run through one of those real quick. We just looked at John Deere. Let's look at Apple, for instance, and a stock that's always on the move. Not a pellet. We want AAPL. You can see this is trading up again at $118. If I believe this is just going to keep on running or kind of stay where it's at, I wanted to take advantage of some movement in here, but I don't think it's going to go shooting really high really quick, even though it potentially could. See, there's a little bit of pullback. We're sitting at the top of the standard deviation channel. I'd expect this to come back down just a little bit. I still like the company. I wanted to get long stock of this. What I can do is sell some puts on this. So let's say I really like the 115 price level. We kind of saw a little bit saw this stall just a little bit at 115 before it bounced the last couple of days. What I can do is sell a put at 115. In this case, we're looking to the December options. These are 24 days away. Look at the 115 put. They're trading for 126 by 128. This is a kind of a narrow spread. I'm going to mention this to cover another question in a little bit. So for 127, 129 now, if I'm going to click on this, I'm going to change this to a sell order. What this is going to do for me, go ahead and click confirm and send. I'm going to collect the $1.27 on this particular $1.28. I guess we went in at to sell this particular option. I'm collecting $1.28. So you multiply that by the multiplier. So typically options trade in a 100 multiplier, meaning one option contract controls 100 shares of stock. So if you were to execute or exercise your one option, you would collect 100 shares of stock on the call side, or if you were to execute a put, you would sell 100 shares at whatever strike price. Since we're doing the opposite of this on the put side, we're selling this put, if the person who sold me this put executes, I would have to purchase shares of stock at 115. With the stock trading currently at 118, that sounds like a pretty good deal. But if the stock dropped down to like $100, say, then I actually would have to buy the stock at a price higher than what it's trading at. But for that little bit of a risk, I get to collect this $1.29 to multiply that by 100 times the number of contracts. So I'm collecting a little bit of premium extra in my account for that risk I'm taking on. If the stock stays where it's at or trades higher, I don't have to do anything. If the person who sold me this put doesn't execute it, I get to keep all this premium in my account. Or if the stock falls and then it gets executed, then I'm purchasing the stock for cheaper than what I was going to buy it at today if I was just going to buy the stock. So that's one example of taking advantage of options to generate a little bit of extra premium in your account. Some of the other numbers that people refer to when they're looking at options, one of the most common things is intrinsic value, and so that's how much in the money the option is trading. We show that within the Thinkorswim software for you. So if you come down to basic, we can go. Actually, it might be underneath theoreticals, option theoreticals in Greek, and we see the intrinsic value. So if we're looking at in the money options, it would really be the only ones that have any kind of intrinsic value, and that's how much in the money, so how far away from the current trade price that option really is. So for instance, if we're trading at 118.60, the intrinsic value for the 119 put would be about 40 cents. The easiest way to come up with that is for calls is the stock price minus the strike price. For puts, it's the strike price minus the stock price. Most software is going to show that for you. If not, that's a good way to come up with it. The other number that's in there would be the time value. There's a lot of Greeks in here, what I've mentioned in the past, but just to try to keep it simple, the time value of the option would be everything over the extrinsic value to what the price is currently trading at. That's the value of the option that's going to disappear as you get closer to that expiration. So if you're looking at the Thinkorswim software, we had that expiration, the number of days in parentheses. So these December options, there's 24 days left. So if we're looking at the 119 put, there's that 35 cents in extrinsic value. Everything else other than now 40 cents in extrinsic value to that $2.85.86. Everything on top of that is the time value. So that's how much you could lose going forward if you're long, or you're going to gain if you're short going forward. That was the entry level into what we're getting into here. Another common question that I got, something I actually talk about a lot, and I believe I explained it once or twice on here, is what is implied volatility. It really really how am I going to use this to trade? So the implied volatility for the option is a forward-looking, and it's a subjective measure of the expected move of a security, looking at a 12-month period. So if you're looking at something that's a 24% move, we basically would take this 24% implied volatility, multiply that by the current stock price, and that's giving you an annualized expected range of where the stock would be trading at, one standard deviation going forward for 12 months from now. To make that more useful, we would break this down into an expected move by that expiration or for a particular time period. And I'm going to get into that actual calculation in a minute or two, but we are doing that for you within Thinkorswim and showing you how much that expected move is based on that implied volatility by that expiration, so how many days going forward. Implied volatility is different than historical volatility. So historical is taking a look at the past trading range of a stock or an option to see how much it's moved historically. Implied volatility is looking forward. How do I use this? Basically, this is going to give you a gauge in whether or not the price is expected to move more violently than it has in the past or less violently. That also comes into play on how the options are trading, how much extra premium, so that time value that we just mentioned, how much of that is built into the option versus its intrinsic value, so how far away it is from the money. Really what this comes down to, if you're looking at the implied volatility, we can take a look at a range on a chart. I don't believe any other brokers have the IV rank, but if they do, great. If not, here's a kind of a quick way to figure out what the IV rank is. An IV rank is really where the current implied volatility is in relationship to how it's performed historically, typically over the last 52 weeks. Most trading packages have implied volatility as a study. So if you're just looking at it visually, you can see where it's currently at. So for instance, we're looking at Apple, implied volatility right around 25. We can kind of see that's roughly kind of in the middle, looking at the study of where it's been, maybe a little bit below. Decently below the average range of where implied volatility has been for the symbol. Not on top, not on the bottom, someplace in the middle. But really the number that we're looking for here is the current IV percentile. We're showing you that this is a 35% percentile. So where implied volatility is sitting between its 52-week range is on the lower portion of that range. Where this is useful, if we know the implied volatility is low, the option pricing premium is going to be generally low as well. So if I have low premium and I expect that this potentially could rise, that premium will increase as we go forward in time. So if I have a long call, I'm purchasing the long call. So let's open this up and give you some real numbers around that. Trade grid option chain. Looking at December 1, so long call roughly trading at $2.50. If the implied volatility increases, we'd expect the price of this to increase as well. So I'll be able to sell this for a profit, even if the stock doesn't move at all. Same would be true if the implied volatility would be high. So if the implied volatility is really high, the option price here would be higher than usual. If volatility started to crush or collapse in a little bit, we would be able to buy this back at a cheaper value. Things that cause volatility to move around, typically that'd be market news. So that's usually why I start off with the what's happening in the market, current numbers, things along those lines. That gives you a good idea of where the volatility is going. So if there's some big news articles or manufacturing numbers are really low or really high, they're blowing out estimates or way below estimates, we could see a big movement in the market, which would increase volatility, which would also increase the individual prices in all of our options. Other big factors around this would be corporate earnings. So earnings announcements, dividends coming up could potentially adjust this as well. So hopefully that gives you a little bit of a better idea of how to use an implied volatility. Also, that addresses the other question that I was going to touch on next, is whether to buy or sell my options or my option spread. Basically, that's really coming down to where's that IV percentile at? Are we looking at current volatility in this particular symbol being low or being particularly high? Also, is there any kind of news coming around which could potentially move the volatility gauge one way or the other? So if you know that your spread is going to expire the day before an earnings announcement or right around an earnings announcement, then you may want to buy that if you have enough time leading up to that, or if it's right coming close to that and the implied volatility is high, then it might be a better time to sell. That hopefully addresses those questions out there in the world. The next question I want to address was, what is open interest? I definitely have touched on this before. Open interest is really the number of open contracts on a particular symbol. How this is useful, really, this is useful to give you a gauge on if there's a lot of liquidity in a particular options market, or even underneath a particular underlying symbol. When we're looking at this, if we're looking to trade a new option, I typically wouldn't suggest trading the option unless there's at least, I don't know, say 50 times the number of contracts I'm looking to trade out there in open interest. That just gives you an idea if there's enough other people interested in the same trades that there is. Generally, the market makers on the other side of that are also interested in trading this. Better chance of getting your fills, being able to get out of this in a more, I guess, fair pricing. I mean, obviously, there's going to be price fair, but the bid-ask spread will be typically tighter on a higher liquidity option. So if we're looking at the option chain here for Apple, we can kind of see that. So if we're looking at there's open interest on these 112 strikes, we're looking at, it was 10 cents, 10 spread. We're looking, there's only 60 contracts open. If we look at something like the 115th strike, where there's 90,000, we're looking at a 5-cent spread. So obviously, there's a much tighter market there. There's a lot more liquidity in those particular option contracts. It also comes down to, how do I know which strike to pick? If I'm trying to determine which strike to pick between two different ones that are very similarly priced, potentially same delta, stuff along those lines, same expiration, maybe a strike or two apart, I would trade the one that has higher open interest. That's just going to give you a better gauge of how much liquidity there is in that particular market. Something like Apple is probably not going to be a big deal, but on more thinly traded stocks, that could definitely cause some issues when it comes time to close a particular position. The open interest number really is all the number of mark-to-open orders minus the mark-to-close orders for a particular day, and this is the number from the previous trading day. So the OCC, so the Option Clearing Corp, takes a look at all orders that are marked to open and marked to close. Your broker is probably going to do this for you. If not, you may be doing that yourself on your order tickets when you enter in a position to mark it to open or mark it to close. With them, Thinkorswim are doing this automatically based on whether you have a position in your account. You can also select that from this little drop-down box, mark to open, mark to close, to open to close. OCC takes a look at all these trades at the end of the day, tallies up the total number of new mark to opens, or the number of trades that are marked to open still for that particular day. And that's where the open interest number comes from. Hopefully that helps address that. That comes into another question I had where people were trading some symbols that had illiquid options. I think Tiffany actually might have been slightly illiquid. Yeah, so some companies they're heavily traded across the board. You'll see a lot of volume in a particular company, but there's not very much volume in the options. This probably is not the best example, but you may have some out there that you're trading, taking a look at. When it comes to these illiquid options, so there's not really any kind of open interest on that particular symbol. The bid-ask spread is pretty wide. Be careful with those. After this break, I'll get into a little bit more of that, but we have this commercial break first.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Options Hour.
And welcome back to the Options Hour. We're just going over some of the common questions that I received at some of the trade shows, as well as what come in through email and on our trade desk here at Thinkorswim, TD Ameritrade. Hopefully we can get everybody out there a little bit more comfortable with options trading, and maybe they'll start trying these out in your portfolio and see if this is something that's right for you. Of course, always try this in paper money before you do it in your real account, just so you have an idea of how these actually function. There is some other risks in there, so always ask your broker or send us an email. We'll be happy to walk you through some of the stuff if you have any questions on it. So another question that we get quite a bit is, should I leg into a trade, or if I'm rolling a position? So we mentioned fixing positions in the last two shows that may have gone against you. How to do this? People were doing, or I got a lot of questions on why would I want to do this as a single transaction as opposed to two separate transactions. The most straightforward answer is for commissions. So if you're rolling a trade, you only have one ticket charge, at least in TD Ameritrade, so you're not paying twice the commissions to execute your trade. Really, you're closing trade for your first position, rolling into a next position. There's only the ticket charge plus your per leg contracts there, so it could be considerably less than if you're trying to do this as a separate position. Also, these get shipped to the market as a single order, so occasionally the market makers are going to want to offset their risk that they're taking out from your position. They're going to look at your spread a little bit differently than they would as a single option. Sometimes this will help you get a better fill. Sometimes it could hurt you, in which case maybe going the single route might be a better option if you're trying to roll anyways. If you're looking to do an option spread, the problem with legging into an option spread, or if you had a broker that only lets you do one particular leg at a time, one option contract at a time, you may not get your best fill. I know a lot of people talk about legging into vertical trades, for instance. So if you're trying to, like a long call option, it starts to go in your favor, and you want to sell some premium against that, turn it into a vertical a little bit later on, definitely could work. The problem is here, if it starts to go against you right out of the gate when you put that trade on, You didn't collect that premium up front. That would have offset the overall cost of your trade, so you're going to have a little bit more risk than if you would have put that on all at one time. So basically, when it comes down to should I leg into a trade, the answer is no. Should I roll a trade as a single roll-in order? The answer is yes. Try to do multiple legs all on the same ticket. Will save you some commissions and help alleviate some risk that you may have otherwise. Some other questions that I got when I was at the trade show where people were referencing stuff that we have in Thinkorswim, but they're trading someplace else, and they may not have these features. I really want to say is come over here. I'm really happy to help you out. But if not, if you're at someplace else for some particular reason, I'm not going to judge you for that. One of the most common things is we mentioned a lot of out-of-the-money stuff, a lot of options people or coaches reference. If you're going to be selling options, you're looking for something that's about 68% expiration or chance of expiring out of the money. Within Thinkorswim, we can show this as a column. So I'm going to go to option theoretical probability out of the money. So this is giving me a value of the expected. Go back to Apple here. How far out of or expected chances are going to be out of the money? Roughly 68%. So if I was going to be selling calls on this, for instance, to collect some premium in my portfolio against stock that I particularly own, I'd look for the ones that are 68% out of the money. The most closely corresponded value to this that's pretty common would be delta. So a delta of 30 is roughly the same as a 68% probability out of the money. So if you have delta, you can calculate these odds here. The higher the delta, the lower the percentage chance it's going to expire out of the money. The lower the delta, the higher the percentage of chance. Going anything higher than 68%, you start eating into your options premium quite a bit. Anything lower, you're going to run into the chances is going to go against you. Something else that we have people ask about comes in terms of the extrinsic value, and really this relates to calls, long or short calls that you may own when it comes around dividend time, and whether there's value in this related to the dividend that's going to be paid and potential risk that you have on that. I'm going to address another question we have while I answer this one as well. This comes down to dividend risk. So people are always nervous about trading options about dividends when they come up. Really, the only side that you should be concerned about is the call side. Long calls, if you own the long call, you don't really have so much dividend risk there because you're the one to control. But what you need to take a look at is it really worth exercising my particular option in order to collect the dividend? With dividends, you do not collect. With options, you do not collect the dividends paid on the stock. You have to execute or exercise your particular option in order to collect that dividend. So if we're taking a look at this, for instance, we're looking at Apple. Let's go to the November 3rd weeklies. There's not dividends coming up, but let's just say that there is. Say there's a dividend being paid tomorrow, or let's say there's a dividend being paid tomorrow on Apple, and we have the 117 strike calls. They're currently trading for $1.40, $1.46, call it $1.45. The dividend being paid is 47 cents. Stock's currently trading at $1.18, so we're 2 strikes in the money. About to be 1 strike in the money if this drops a little bit, but anyways, what we really want to do is see what the extrinsic value of this is. So if you have the column extrinsic value, you can add this to get an idea of how much this is really worth versus the cost of the dividend. If the extrinsic value is the same price of the dividend or higher, this would be worthwhile to exercise that particular option. If it's lower than the option, then it may not be worth it. I'm sorry, that's backwards. If the extrinsic value is lower than the dividend, you'd want to exercise. If the extrinsic value is higher than the dividend, you would not want to exercise. It would not be worth exercising that particular option in order to collect the dividend. If you don't have the extrinsic value, the easiest way to see this is something that's really, and the price is really close to it, is in the money calls, the corresponding put value is roughly the extrinsic value of the option. So if you're looking at an option change, you can kind of get an idea whether it's worth exercising these particular options in order to collect the dividend. So right now we're looking at these 117 calls currently trading about 120, another at 128. The corresponding puts are 40 cents. If I was going to exercise this, the dividend's at 47, this would be worth it. If you're one strike higher where the puts are trading at 80 cents, there's a 47-cent dividend, it would not be worth exercising this particular call. That's on the long side of this. If I short this call, I can use that same knowledge to come up with the whether I have to worry about closing out of this before that dividend's paid. Typically, the same is true. So unless somebody makes a mistake and accidentally exercises something that probably shouldn't have been exercised because it wasn't in their favor, if you're short the call, you would also be responsible for that dividend as well. So you'd have to sell the person who owned that call the stock, as well as pay them the dividend for that after the ex-dividend date. So take a look at ex-div date. That's when you'd be out of this. You'd need to be out of this particular trade by if that put was trading lower than the actual dividend. So hopefully that helps answers how to handle the dividend risk with options. If you have the extrinsic value, that's going to give you the best number for this, but the corresponding puts price will be pretty close to that, if not dead on already. So just to clear that up, calls, if the corresponding put is less than the dividend, it's worth exercising to collect the dividend. If it's not, then it's not going to be worth it. I mentioned earlier the expected move. So when we're looking at the implied volatilities, we get the expected move. If you're looking at the screen within the Tiger's Den, you see my mouse is sitting over an expected move with an implied volatility. The expected move we're calculating out on that. I've given you this a couple times where you can kind of calculate this by pricing out the current at-the-money call and put straddle, so the corresponding call and put. Pricing that out is going to give you a generic expected move. Really how this is calculated is by taking the stock price, multiply it by the implied volatility, and then you multiply those two numbers by the square root of the days till expiration. So for instance, if we're looking at this, the same 117 strike call marks $3.05. We'd multiply that by the 24% volatility, so by 0.24, times the square root of the days till expiration, in this case 24. Once we have that number, we're going to divide that by the square root of 365, and that's actually how this expected move is calculated right there. So if your software is not calculating that out, you want the real value. That's the long math for it. Really, I think pricing out the at-the-money straddle is probably going to be a little bit easier for you. Another question I had, and I mentioned this a little bit earlier, is buying leaps. Generally give you a 1-to-1 move with the stock. I was asked if this is a good scenario, a good way to use options to take advantage of moving a certain stock. My answer with this one is yes. If you're going to be bullish on a stock and you're looking to purchase options and you want to hold these for a longer period of time, other than a shorter term expiration, which we showed can give you a bigger return, you'll notice that the farther out expirations are considerably more expensive. That has to do with that time value of the option, which I mentioned a little bit earlier, which is basically the stock price minus the strike price, gives you the intrinsic value. The time value is that options price minus that intrinsic value. The farther out you are, the bigger value we have in these. If you're trying to get a 1-to-1, the best way to do this is look for something that's roughly an 80 delta. Would give you the best 1-to-1 movement, as well as something that's about 20% of the underlying would probably be the best leap to purchase. Within Thinkorswim, we could scan for this. I'm running out of time, so I'm not really going to build that. But just want to point out, so when you're looking at an option chain, we'd expand this so we can try to find something that has an 80 delta if it's available, or look at something that's about 20% of the underlying's value. That would give us the closest to a 1-to-1 movement for the stock, and also the most value for it. If we have that as an ability to purchase those, that's the one that I would go with in those leaps. Once we have those leaps, that's not where I would stop. If I'm trying to use options to gain a little bit more value or more bang for my buck in trading an underlying symbol, something that I'm bullish on, start selling closer calls on the symbol. So when you're looking at calls, again, we're looking at something that's a 30 delta, roughly a 30 delta in a short-term expiration. I'd go about 25 days out, give or take a little bit. Find something with a 30 delta, 35 delta if that's available, somewhere right around there. And sell those calls. Actively monitor these. This is basically what we're doing is turning this into a diagonal spread. So we're selling a front month call when we have our long-term expiration call. It's something that's quite a bit farther out. As we get closer to the expiration of the short-term calls, we'll buy those back and then sell the next expirations, possibly moving up or moving down depending on where the stock moved, or maybe it's the same option. And I would want to do that closing of the shorter-term trade, rolling it out to a little bit longer as one trade. So that'd be a rolling trade. Basically, this is just doing a diagonal. The idea is every time we sell the call here, we're lowering our overall cost that we paid for the put in the far back month expiration. So in this case, let's look at the January 17 calls here. Let's say we sold the 95 for about $30. If we come back up, that's 786 days away. So if we look at the current 30 delta calls, let's say we get $1.50 for these. As we go forward, every 25 days, every 24 days or so, we're going to roll these to another expiration. So how many times can we do that in there? 4, 8, I don't know. Probably get down those back month calls down to originally paying maybe $10 for them, where we paid $30 to begin with when it comes close to the expiration, drastically lowering our cost basis here. So if the stock doesn't move at all, we're gaining money on these as we go forward. That should be a little bit more aggressive than just the time decay that we're going to see on those options. But we are bullish, so we're expecting this to go up anyway. So not only are we getting a positive movement forward, we're also discounting it based on the sold calls on the front months. That's coming close to a close here, so hopefully that was enough information for you and hopefully clear enough. But if you do have any questions, feel free to email support@thinkorswim.com or call in next week during the options hour. I'll be happy to answer your calls, walk you through any of that. At the end of the show, we're looking at the SPX, pretty flat. We're at 2070 just off an all-time high again. Dow Jones sitting at 17,836, 837. They're up about 0.1%. The VIX is down 0.5%, sitting at 12.5. Not a whole lot of movement going on right there in the day after we had kind of flat numbers coming out from the Fed. That about wraps up what I have for you today. Again, if you have any questions, any options questions, any trade-related questions, things related to Thinkorswim, please email me at support@Thinkorswim. This is Chad with the Options Hour. Have a good one.
Told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You're watching Tiger TV.